Welcome to the Lifestyles Unlimited Real Estate Investor Radio Show, a real estate investment program. Listen and learn how to use real estate to build wealth and passive income streams for you and your family. We bring you experts every day to discuss and answer your questions on everything from single-family homes all the way up to 600-plus unit apartment complexes. And now, the Lifestyles Unlimited Real Estate Investor Radio Show.
Welcome to the show. My name is Al Gordon, and as always, we're here working on your financial freedom. On today's show, the topic is simply this: why you should be a real estate investor. It's a pretty simple, pretty straightforward topic, but I'll tell you, there are folks out there that don't understand this whole concept of being a real estate investor. A lot of you think that the way to retire is to put your money into a 401k or an IRA or a SEP, or possibly rely on pensions that maybe your employer is providing for you. And that's going to be your path to retirement. But I'll tell you what, Americans are terrible savers. So the question I've got for you is this: do you lack the self-discipline to put a monthly deposit into your IRA or your SEP or your 401k? Now, I know some of you are forced to do it because that's what your employer requires you to do. But others of you can make voluntary contributions. You don't necessarily have a automatic deduction going through your payroll. But when you think about buying a rental property, it's a significant commitment that you're required to commit to and maintain. You will always be grateful in the long run when you don't give up on it and build future cash flow and wealth. So let's talk about some of those tangible benefits that are associated with being a real estate investor. And it will help to solidify in your mind why you should be investing in real estate. Now, the first thing that you have to consider, and this is the number one thing. If you listen to my mentor, Del Walmsley, he will tell you day in, day out that cash flow is king. Cash flow is the most important consideration when you're looking to invest in residential income producing properties. He'll be the first to tell you, if it doesn't cash flow, don't do it. No matter if you're looking at a property and you think, this is a beautiful property, or it's not so beautiful of a property. If that property can't cash flow for you, just walk away from it. That's right. You heard me. Walk away from it, because cash flow is very important. You know that many people invest in rental properties simply because of the cash flow. Did you know that? The extra money, and cash flow is this: it's the extra money that's left over after all the bills have been paid on a rental property. The cash flow can provide ongoing monthly income that is mostly passive, allowing you to spend your time building a business, traveling, or reinvesting in more real estate. And cash flow from real estate is stable and far more predictable than other businesses. The cash flow can help float you through the bad times and live well during the good times. So that's an explanation of why cash flow is so important. Cash flow is that income that just keeps coming in, and it comes in monthly or it comes in quarterly, depending on how you're invested, what type of assets you're invested in. Most single-family properties tend to produce a monthly cash flow. Most multifamily properties can produce a monthly cash flow, but a lot of times distributions are made on a quarterly basis just because it's a little bit easier to do that thing. And if you're a passive investor in multifamily, you definitely know that those distributions are probably coming to you on a quarterly basis. So it's a reason to have a party, around the 15th of the first month of the quarter, because that's usually when those checks drop. And I'll tell you what, when those checks drop, it's a good thing. It's a really good thing, because it's money coming into my coffers that I can use for anything I want to use it for. I can use it to, for instance, my daughter went out of town. And while she was out of town, we had some work done on her car. Now, one of the things that she had always wanted was a rear mount or a hidden mount bicycle carrier, okay? Because she's hopefully she's not listening, but she's too short to use a bicycle carrier that, you know, could go on top of the car. She couldn't reach up there to get it. Even with the stool, it would be, you know, kind of perilous. So she's always wanted that behind the car carrier. So what we did was we used our cash flow for this month, and we took the vehicle into the dealership, and we said, look, we need a rear hitch put on this vehicle, and then we want to buy the hitch mounted bicycle carrier. And they accommodated us. And you know how we paid for it? We paid for it based on the cash flow that comes into our household on a monthly basis. See, we can use that cash flow for anything we want. We've used it to go on vacations. We've used it to buy additional income producing real estate. We have used it just about any other way. I mean, sometimes I use it just to take the family out to dinner because it's a nice time. It's a great opportunity for me to spend with my family, and it gives me an opportunity to kind of give back to them because, you know, they've put up with me for so many different years. You know, another reason that you should be investing in real estate and you should be a real estate investor is the appreciation of real estate. And while the loan is being paid down, the value of real estate generally goes up. Yeah, I know. Recessions do happen, values do go up, and they do tend to go down from time to time, and people buy at the wrong time of the market. I get that. I totally get that. However, over time, values do climb higher and higher. That's why I'm not in this real estate game just for a year or even a decade. I'm in it for the rest of my life. I know that my properties will continue to climb so that 30 years from now, everything will be worth far more than I'm paying for it today. And the neat thing is this: you can grow tax-free. You see, buying rental property based on speculation of its value is a dangerous tactic since cash flow is the key. Remember what I said earlier? Cash flow is the key. Remember, appreciation over the long run is certainly realistic, and at the least, you should be considering a tax-deferred strategy. In the future, you might even consider a 1031 exchange or a charitable trust or an installment sale to lessen your tax liability further. Now, these are complex topics. These are really more for some of the advanced real estate investors, but I'm letting you know that these topics are out there, that these things can affect you. And most importantly, what I want you to do is go out and get yourself an education on how to properly invest in real estate. Otherwise, whatever you do could be perilous. We'll be back right after this.
Welcome back to the Lifestyles Unlimited Real Estate Investor Radio Show. It's time to turn up the volume and fine-tune your passive income plan so you can create the lifestyle you've always wanted.
Welcome back to the show. My name is Al Gordon, and as always, we're here working on your financial freedom. On today's show, I'm just addressing the topic of why you should be investing in real estate, or, you know, to put it a different way, why you should be a real estate investor. You know, at Lifestyles Unlimited, we live by a set of rules, and the set of rules are very simple. And there's 5 ways that we make money in real estate. We make money by cash flow. We make money by appreciation. We make money by equity capture. We get money based on principal pay down, and there's a wealth of tax benefits that go along with it. And if you're dealing with multifamily, there's a little thing called forced appreciation out there, which is just phenomenal. It is just phenomenal. Now, what we've done so far on the show is I've gone ahead and I've talked a little bit about the cash flow, and I've talked about appreciation. So that leaves us the rest of the topics. But what I want to stress to you is this: it is so important for you to get your head around this, that if you don't do it, you are doomed to working until you're 60, 65, or 70. You're doomed to trying to put money into those IRAs or those 401ks or those SEPs, or, you know, relying on those pensions that may or may not be there for you when it's time for you to quote unquote retire. Why not get on a glide path where you can get yourself retired in less than 5 years. We have a group of members at Lifestyles Unlimited called the Deuces Only Club. These are people that came to Lifestyles Unlimited. They followed the map. They followed it correctly, and they were able to get themselves retired in 2 years or less. 2 years or less. And I'm here to tell you, I'm proud to say that I'm a member of that club. Now, I'm not bragging. Please don't get me wrong. I am not bragging. I am not trying to poke you in the chest. What I'm trying to tell you is that there is a better way. What you're doing is ineffective and it needs to change. It's that simple. If you keep following the path that you're following, you're going to get a result that you don't want to get. And if one of your end stated goals is to get yourself retired, then you need to look at real estate investing as the conduit to get you there. Because I'll tell you what, that stock market, I don't think so. Yeah, it's doing great. Don't get me wrong. The stock market is doing wonderfully. And for all of you that, were biting your knuckles and chewing your fingernails and watching the market do what the market did, a year ago this time, the sting of the stock market. That stock market can do whatever it wants because it's controlled by market forces, and there really isn't anyone or anything that can really move the direction of the market. Yeah, there's people that say those big institutional investors out there, they can actually move the markets a little bit. Yeah, and you know what? There's probably some truth to that. But you got to remember, these are massive organizations that are pushing a ton of money into and out of the stock market. That's different than you and I, that, we don't necessarily have a ton of money, not like those big institutional investors have. So if you are focused on the stock market for retirement, I want you to sit back and I want you to consider changing your venue. Consider it. I've been watching a lot of these ads on TV, for gold, for silver, for mutual funds. I saw one the other day, a financial planner or investment firm or whatever they want to call themselves. They basically said, if you've got $500,000, then you need to be investing with us. And I will tell you this, if you've got $500,000, you should be investing with us, not them, with us. Because I'll tell you what, with that $500,000, you can do great things. Now, let's just assume that $500,000, it's your money, by the way. It's your money, okay? I'm on your side there. I believe it's your money. But the government is going to charge you taxes and interest to take it out. So we'll just assume that's about 30%. So we'll multiply that $500,000 by about 30%. That gives us about $150,000 in taxes and penalties. And you're probably sitting there going, wow, that's a lot of money to walk away from. Why would I ever walk away from that kind of money? $150,000 is a lot of money to walk away from, but when you sit down and you look at the potential for what the rest of that $350,000 can do for you, it's a game changer. That $350,000 can get you retired and get you into the Deuces Only Club, or it can get you to what most of our members do, which is retire in 5 years or less. So let's consider this. You're 45 years of age. You're not anywhere closer to retirement than you were when you started listening to the show. As a matter of fact, you're just going through the motions. You maybe are listening to the show in the background, but what I want you to do is I want you to consider, if you were to tap into that money, if you had that $500,000, you paid the taxes and the penalties on it, and you had $350,000 remaining, what could you do with that money? There's a lot of things you could do with that money. But I want you to hold that thought for right now, because what I want to do is I want to get back into my discussion of how real estate's going to make you money 5 different ways. And actually, I've got some more things that are in addition to what Del Walmsley puts out, because I've done extra research, and to be honest with you, everything that I'm going to put out is nothing new. It's not something that Del hasn't put out before, so it's not like I'm inventing a brand new wheel. All I'm doing is being the messenger. So don't shoot the messenger, just listen to what the message is. So there's a little thing called appreciation. Now, when you buy properties over time tend to appreciate. And while the loan is being paid down, the value of the real estate generally goes up. Okay. Yeah, I know recessions happen, values go up and down. People buy at the wrong time in the market, and I get it. However, over time, values do climb higher and higher. We talked a bit about that in the last segment. So let me move on to another tenet that is very important, and this one is called equity capture. Equity capture is huge, okay? And remember that you make your money when you buy the property and you realize your money when you sell it. That's what equity capture is all about. You do not want to buy a property for market rate because you don't have any money to buy the property. Okay. Well, I'm not sure I made that very clear. Well, let me give you an example. Okay. If a property is worth $125,000, okay, and you can buy it for $100,000, your equity capture is essentially $25,000. Now, I'm making this very simple because I just want you to understand it. Conversely, if you were to buy that property for $125,000 and the market value is $125,000, you haven't captured any equity, and the reality of it is you're not going to really make any money off the purchase of the property. You see, we make our money when we buy our properties. We go in and we look at these properties, we analyze these properties, we make a determination as to whether or not the property is going to perform for us based on our investing guidelines, based on our investing goals, while conversely, not conversely, but in concert, following the map, following Del Walmsley's map to financial freedom. And I'll tell you what, it all works. It works swimmingly well. And I'll tell you what, when we come back from the break, I'm going to finish up on some of these topics that we're talking about with regards to why you should be a real estate investor. And I'm going to get into some property deals so that you can understand the numbers. We'll be back right after this.
With the Lifestyles Unlimited Real Estate Investor Radio Show. We're here to answer your questions and help you become financially free.
Welcome back to the show. My name is Al Gordon, and as always, we're here working on your financial freedom. Today's topic, why you should be investing in real estate, or simply put, why you should be a real estate investor. Now, in the previous segments, I went over a few things that are very important to you as far as becoming a real estate investor. These are things that real estate produces for you that you need to take advantage of. It's that simple. We talked about cash flow and how cash flow is king. We talked about property appreciation. We talked about equity capture. Now let's talk about another thing that benefits you when you become a real estate investor. It's the loan pay down, or as we like to refer to it at Lifestyles Unlimited, principal pay down. So when you buy a rental property using a mortgage, your tenant is actually the one paying the mortgage payment, thus increasing your net worth each month. Because of the loan pay down, a rental property is essentially, now get this, essentially a savings account that grows automatically without you depositing money each month. Wouldn't it be nice to have a savings account that you didn't have to put money into, but it just kind of grows and it grows and it grows? Well, Let's put this in perspective. So let's say today you might owe, I don't know, let's pick a number, $200,000 on a rental property. Let's just go with that number. But next year, you might only owe $195,000 because the tenant is making the payment for you, which ultimately transfers into making you $5,000 richer or $5,000 in wealth. Okay, 30 years down the road, or whatever the term of your loan is, it will be paid down to zero. You own a significant asset that you can sell or continue renting, all thanks to your tenant paying the mortgage. And that's why it's so important, to be honest with you, to find the right tenants. Not having the right tenant is going to cause you all kinds of grief, okay? And one of the things that we do at Lifestyles Unlimited as part of our educational programs is we teach you how to properly screen tenants. It is very important for you to screen tenants correctly so that you get the best of the best. What you don't want is somebody coming in and abusing your property. You don't want them leaving in the middle of the night. You don't want them tearing the place up. Okay, what you want is tenants that are responsible, tenants that have a history of paying their rent on time, tenants that have a history of taking care of your property, tenants that provide you with a reference list of who their current or their previous landlord was, and you should ask for the landlord's information prior to that. Now, why should you do that? Well, it's very simple. The first landlord may want to get rid of the people. I mean, they just want them to go away, in which case they may or may not be completely open and honest with you regarding the tenant history that those tenants have with that landlord. But if you go to the previous landlord and you ask them, how are these tenants? So how did they perform? Did they pay their rent on time? Did they take care of the property? That landlord is going to be brutally honest because they've got nothing in the game. That tenant has already come and gone. That tenant has already left some kind of impression upon the landlord, and that landlord is going to share that information with you. Very important stuff. Now, keep in mind, tenants are people. Tenants have rights, and tenants, for the most part, can be very responsible people. All right. So make sure that you're screening them correctly. And if you don't know how to screen them correctly, you need to get properly educated like we teach at Lifestyles Unlimited. Now, there's another benefit to owning real estate, and another reason why you should be investing in real estate. And it's as simple as this. There are significant tax benefits. It's no secret that because of depreciation and mortgage interest deductions, that is, if you leverage your capital, and we recommend you leverage your capital, you shouldn't be using all cash. There's a myriad of reasons why, and we've covered those in other radio shows. Your cash flow ultimately should be tax-free. Let me say that again. It's no secret that because of depreciation and mortgage interest deductions, that your cash flow should be essentially tax-free. That's right. The vast majority of time, an investor will never pay any taxes on their cash flow and can wait for capital gains on the sale of their property in the future. So let me ask you a question. And it's a very basic question, but it's an important question. If you were to earn $100,000 at your own business, let's say you're self-employed. Okay, some of you out there are self-employed. I know, I've met some of you. If you earn $100,000 at your own business, and I earn $100,000 through rental properties, who gets to keep more money? Yeah, go ahead, scratch your heads. Think that one through for a minute. Yeah, for those of you saying, Al, you do, well, you know what? You're right. For those of you saying, I do, not meaning Al does, but you do, you're not correct. And the reason why folks like me that can earn $100,000 through rental properties gets to keep more money, it's because the government rewards rental property owners. Not only is the cash flow received from your rentals not subject to self-employment tax, the government offers tax benefits including depreciation and slightly lower tax rates for long-term profits. And depending on your classification as an active investor or a real estate professional and your income level, there is a good chance your rental property will not only give you tax-free cash flow, but an overage of tax deductions you can use against your other income. With that said, this is something you want to discuss with your tax professional before investing so your expectations are realistic. And keep in mind, I am not a tax professional. I am merely a real estate investor who has a lot of experience doing it, who is conveying my opinions to you. But what I want you to do is I want you to qualify some of those opinions. And when it comes to taxes, that's definitely one you need to qualify completely with a tax professional. Now, rental property affords investors with another incredible opportunity to convert personal expenses to potentially valid business deductions. Don't forget that real estate is in itself a business, okay? Rental real estate is a business. This means that travel expenses to check on your properties and payments to family members who manage your properties, I don't know, maybe it's a student away at college, can be deductible and increase the tax payments when it comes, the tax benefits, not the payments. Oh my goodness, no, we're going the opposite direction. There's tax benefits when it comes to cash flow and the future sale of the property. And keep in mind, real estate is essentially a hedge against inflation. Can you imagine paying $10 for a gallon of milk, or $5 for a candy bar, or $30 for a gallon of gas? Now, while those prices seem very exorbitant to you, this is the future because of inflation. Inflation is the process by which prices increase due to the value of money decreasing. And while most people fear inflation, as a rental property owner, I actually look forward to it. So when the price of a gallon of milk hits $10 a gallon, guess what else is going to shoot through the roof? Everything, including rents and property values. So the one thing that won't increase, however, is my fixed rate mortgage payment. That's going to stay constant because that's locked in. And as inflation pushes the cost of living higher and higher, my cash flow will only increase. This is why real estate is often called a hedge against inflation. When inflation hits, I'm ready. So you need to be ready when inflation hits. You've got to have yourself some rental income producing real estate. It's just the way it is. And you know what? You can gain more than just leverage. Real estate is one of the few investment vehicles where using the bank's money couldn't be easier. The ability to make a down payment, leverage your capital, and thus increase your overall return on investment is absolutely incredible. And when we come back, I'll finish up my discussion on why you should be a real estate investor, and I'll get into some of those sample deals so that you can hear how real estate can change your life. We'll be back right after this.
Welcome back to the Lifestyles Unlimited Real Estate Investor Radio Show. Now, let's get back to your map to financial freedom.
Welcome back to the Lifestyles Unlimited Real Estate Investor Radio Show. My name is Al Gordon, and as always, I'm here working on your financial freedom. On today's show, I'm just, basically saying this: why you should be investing in real estate, or to put it in a different way, why you should be a real estate investor. Now, throughout the context of the show, I've talked about the things that you need to consider, things that will affect your life positively when you become a real estate investor. I talked about cash flow. I talked about appreciation. I talked about equity capture. I talked about principal pay down. I talked about the tax benefits. I talked about how real estate is a hedge against inflation, and I talked about how you can leverage your properties correctly. Now, what I'd like to do is get into a discussion of something called forced appreciation. And forced appreciation is definitely not a new concept when it comes to real estate investing. It's a strategy used by real estate investors to increase the value of a commercial property. So in our case, the commercial property is going to be multifamily residential properties. We don't invest in retail shopping centers. We don't invest in industrial properties. We don't invest in raw land. And there's a myriad of reasons why we don't do that. And the simplest explanation is this: when the crash hits, people will always need a place to live, but they won't always need a piece of land. They won't always need a place for their business. They won't always need a place to sell items. And I'll tell you what, retail, I'm a little nervous about retail, just on a side note, just because there's so many bricks and mortar types of businesses that I have seen shutter their doors because there's all these online businesses that are out there providing the same goods and services. So, something to think about. And, I drive around, I see all these retail I just wonder how do you do that? How do you invest all kinds of capital into a property only to have it barely leased? That just doesn't make sense to me. All that does is it creates negative cash flow. It just means that whoever owns those properties is every month digging into their pocket to make up the difference for what they're leveraged on the property, or if they're all cash, they're not making much of a return. So forced appreciation is definitely a cool thing. It's a universal fact that the value of an investment property is based on the income that it generates. If you can increase the income from a property, you can increase its value in the long run. And this is where forced appreciation comes into play. Now, an increase in the value of your real estate due to changes in the property market is referred to as natural appreciation. It occurs when the demand for properties outweighs the available supply. Changes in the interest rate or inflation are the other major factors which significantly contribute towards the capital appreciation of your property. A real estate investor basically has no control over the impact of natural appreciation on an investment property. However, the returns from the property can be augmented through forced appreciation, which refers to an increase in the value of an asset due to investor actions. This typically means, well, this type of appreciation is not affected by the unrestrained market forces and is actually the investor who, through proactive measures, can have an impact on the appreciation of the property's value. Now, just to give you some ideas of how you can increase the value. Now, at Lifestyles Unlimited, when you go through our 2-day financial freedom course, we give you a list of 29 different things. I'm not going to go through all 29 things. I'm just going to hit a couple of them here, just so that you can understand how you can force appreciation on a property. And again, this works in multifamily. It doesn't really work in single family. So if you've been hearing gurus out there saying, well, you can do forced appreciation on single family, I'm here to tell you, no, it doesn't work that way. So one of the things you can do is you can increase the monthly rent. Yeah, on properties, you can increase the monthly rent. Or you can do some work on the exteriors to make those exteriors pop, or you can add extras to the property. Maybe it's a dog park, maybe it's a children's playground. Maybe you go in and unearth that pool that got buried 10 years ago, and you bring it back to like new conditions so that the tenants have a benefit there. I don't know. The other thing you might want to do is decrease the expenses. But more importantly, what you're trying to do is you're trying to do things to the property that are going to ultimately increase the value of that property. Now, one of the things my friend Pam did was she built storage lockers on one of her properties. She's got a 77-unit apartment complex, and if I remember correctly, she built something like 14 or 16 storage units, which she rents out for $25 a piece. Now, when you think about that, she's getting $25 a piece, and I think it's 16. I think she's got 16 storage units. That's about $400 a month in additional income that she's receiving. And that's additional income that goes not only to the valuation of the property, but to her bottom line. That's pretty simple. It's a pretty easy thing to do. And you can do it too. Guaranteed, you can do it too. Now, let me talk about something else that I think is very important for you when you want to consider, why you should be investing in real estate and why you should be a real estate investor. And it has to do with a little thing called control. Now, I don't like my destiny tied to a boardroom on Wall Street or a nervous CEO in Silicon Valley. This is why I choose to invest most of my income in real estate, knowing that I am the one who is responsible for my success or my failure. If I want a better deal, I need to hustle to go find it. If the rental market gets more competitive, I can compensate by increasing my advertising for the properties. If values drop, I can choose to wait it out or improve the property to drive the values back up. In other words, I get to control the situation and my financial future and with my two hands. And that suits me just fine. Don't think about let me say it this way. Don't think that just by owning some rentals, you're instantly going to begin building wealth. Real estate is powerful, but only if you work it right. You must, and I cannot state this more clearly, you must learn how to find great deals. You must learn how to evaluate a real estate investment and how to finance any properties you want to buy. Additionally, you must treat it like a business and nurture it as it matures. It's likely not going to be totally passive up front, but as millions of individuals throughout history have discovered, the payoff is well worth the journey. So these are just some of my thoughts on why you should be investing in real estate. I think that, in my opinion, and the opinion of 40,000 members of Lifestyles Unlimited, as well as my mentor, Del Walmsley, the CEO of Lifestyles Unlimited, we think your 401k, your IRA, those pensions, we think those are things of the past. We think that those things will not create a retirement that you're going to enjoy when you get to the point of retirement. And remember, retirement is an age, or is it? Is it an age, or is it? Or is it money? Maybe retirement is money. I don't know. Sit back and think that through. A lot of us think that, well, I got to work until I'm 65, or I've got to work until I'm 70. And I'm here to tell you, no, retirement is not an age. Retirement is a financial position. Retirement is putting yourself into a position where you have more passive income coming in than you have expenses going out every month to support your household. When you do that, you have effectively retired yourself, and that is a good thing. Now, I promised you I was going to get into a deal that one of the Lifestyles realtors just sent out, and this deal came from my buddy Casey. It's a 4-bedroom, 1-bath property located in the San Antonio marketplace, 1,760 square feet, and built in 1963. So it's almost the perfect property. We like to look for 3-bedroom, 2-bath, 2-car garage. This one clearly has probably a converted garage, giving it the 4th bedroom, and it's a little bit bigger in square feet, which leads me to believe that maybe that extra square footage came from a garage conversion. But here's the deal. Casey says that this particular property has an after repair value of $140,000, meaning that when it's all fixed up and it's ready to go, that like-kind properties in the neighborhood are selling for about $140,000. He says we can buy it for $110,000. And you know what? I believe him, because Casey knows what the heck he's doing. So we can make an offer for $110,000 on this property, and based on what we know it's going to cost about $4,000 in repairs to do this deal. So at the end of the day, we're probably going to use some hard money to acquire the property, because that keeps our cash out of pocket as low as possible. As a matter of fact, our estimated cash out of pocket on this particular deal should be in the neighborhood of around $19,000. And with the repairs of about $4,000 that we're going to use our hard money loan to help offset, we're going to be doing just fine. As a matter of fact, this particular property has the potential to return $16,000 in equity capture. That's right, $16,000 in wealth. It also has the potential to return $346 a month in rental income. That's what the average rents in the area are going for. Or to give you over a $4,000 a year increase in your net worth and the money that you can spend. Now think of it. What a great thing. These are reasons why you should be investing in real estate. And if you're listening to this show, you know I'm right. And remember, everything we do at Lifestyles Unlimited is not for the money, but it's all about achieving that lifestyle.
The Lifestyles Unlimited Real Estate Investor Radio Show is for entertainment purposes only. Please consult a professional regarding your personal investment needs. Nothing presented on the Lifestyles Unlimited Real Estate Investor Radio Show constitutes an endorsement, recommendation, offer, or solicitation to buy or sell any product or security.